Well, thank you everyone for joining today. Today we are presenting agency condo insurance requirements. This is really an in-depth guide to as it's outlined here to identify, determine, and ensure insurance lending compliance in condo properties. Joining me today is a longtime rock star employee of CondoTek, Mercedes Good. Mercedes is our Director of Lending Compliance. Um, Mercedes, how long has it been? Has it been about over a decade or close to a decade that we've worked together? I think so,
Yeah,
right?
around there.
Around there. And Mercedes has an incredible amount of knowledge on insurance lending guidelines, insurance policies. She's truly our resident expert here at CondoTek. Really looking forward to having this presentation with her today. So a couple of cleanup items just to start. This presentation is scheduled for an hour. We usually try and end up around, 40, 45 minutes. So we leave a couple of minutes for questions. Regarding questions, please utilize the Q&A feature in order to ask your questions, not the chat feature. The reason for that is we like to kind of keep all the questions in one place. Are going to try and answer some questions on this presentation, should you ask them. The problem that we have with insurance questions in a presentation like this is that sometimes they're incredibly specific and not broad. And if they're incredibly specific, it sometimes takes a little, a few more questions to answer that question appropriately. So we will try and endeavor to get to all of these questions within a couple of days after the presentation, and we will email you out, everybody who has attended, a list or an outline of the answers to those questions should we be able to answer them. So, without further ado, I know there's going to be people joining as we start, but let's run into this. We really try and stay on time when we do these presentations. On this call today, we have a lot of people on this webinar, close to 500 people, I think, are attending today. And there's a lot of information to provide to you. So let's jump into it. So, who's CondoTek? CondoTek really provides tech-enabled products into the lending industry, and we provide a lot of products for not only lenders but also developers and homeowners associations in order to ensure residential mortgage lending compliance. Our products that are most utilized within the industry are our Condo Pack product, which is our documents only product that a lot of lenders utilize in order to do their own reviews internally. And our condo project warrant product, where not only do we provide documents on condominium associations, but also provide a warranted review of that association to Fannie Mae or Freddie Mac lending policy. And recently, we launched a product called a lending compliance report. And that is primarily utilized by associations looking to determine whether or not their specific association, condominium association, or community, or cooperative community, is compliant with agency lending guidelines. So essentially, we took our condo project warrant product, which was available for lenders, and offered it out into the industry. This product has been, it's been a leading source of information for those associations that really wasn't readily available within the industry before. And now an association can contact us and obtain that lending compliance report. Um, it's again very unique because it's now being utilized by some lenders who utilize it as an incubator for future lending within condominium development should they not be compliant. And I'm really happy that we were able to introduce that product into the industry and the success with which we're seeing condominium associations become really involved in the process of ensuring mortgage compliance in their communities. Those aren't the only services we offer here. We do offer several services for new construction developments, Fannie Mae global site-wide project approval through their PERS process, and our partner lenders, FHA project approval, VA project approval, and portfolio lending approval. If we have a new construction community or a community that happens to have an unavailable for lending designation, we do offer services to get those communities approved with lenders who will provide non-warrantable financing or portfolio mortgage financing in those communities. So very proud of the services we provide here. I'm Orest Tomaselli. I'm the president of Project Review here at CondoTek, and I'm the king of all condo webinars, it seems. We're doing anywhere between 6 to 8 of these webinars a month and across the industry. Tomorrow we have a very large webinar in Florida, one of the really impacted states, that we're seeing, regulatory changes there and mortgage challenges there. One of the states that we see a lot of reviews from as well. And really happy to be in this position and to try and provide some guidance. So outside of all that, let's run into what's going on with condominium insurance. There are some major compliance challenges that we're seeing in the industry. On average, we review between 1,500 and 2,500 condominium and cooperative properties and communities per month here at CondoTek. So we have a lot of data based upon the reviews and the information that we're receiving from the industry. Obviously, even with an article today that just came out about Florida and State Farm, we're in a massively rising insurance cost environment. We're seeing increases over the last 24 months of anywhere between, I used to say 10%, but now it's closer to 25% to 300% increases in condominium insurance policies across the nation. And God forbid your condominium community is located anywhere near the water, or on the water. We're seeing, massive increases for insurance costs. And those cost increases really are driving non-compliance. And I'll walk you through that and outline why that is. Carriers are now declining policy continuation. They're now requiring, in some instances, a property condition analysis or a reserve study to see what the structural and mechanical condition of the property is before continuing a policy or even providing a new insurance policy to the community. Again, these policies are offered at a much higher cost than they were before. Should an association have a claim, or several claims over the last 24 or 36 or 48 months, we're seeing massively increased costs for those associations just by requesting a claim on their insurance policy. As a result of these insurance increases or cost increases, we're seeing increased deductibles that may not be compliant. So Mercedes and I are going to delve into that as well today. And that kind of makes sense because, residential homeowners and condominium developments are trying to make ends meet. So if their increased insurance costs are 100 or 200% or 300% higher than last year, one of the ways to tamp down their insurance costs is to get higher deductibles. And those higher deductibles, especially if they're over 5%, are not compliant with agency lending guidelines. And we're seeing a lot of properties across the country, becoming non-compliant because of those deductibles. Policy terms are requiring review and update. So in the past, it wasn't as difficult to review an insurance policy for a condominium association, but you really have to look at things like actual cash value and guaranteed replacement cost and the special forms and all risk form and the perils that are covered. There are changes to guaranteed replacement cost and actual cash value guidelines. You have to look for inflation guard, and there has to be an annual review. And of course, there are geographic limitations now for insurance policies across the country. Obviously, as a result of these acts of God that we're seeing, the wildfires in California, hurricanes in Florida, and several other acts of God, instances that we've seen across the country, floods and such. We're seeing that insurance carriers are just not willing to provide insurance in certain areas. So it's been a really difficult time for associations um, to comply. The comment I have to make here, though, is that there's something that's changing in this marketplace. And what's changing is in the past, I'll say, let's say a year ago, we would have a lot of difficulty talking to an insurer or a carrier or making them understand that the policies had to change or that their policy wasn't compliant, or even having a conversation with them about the policy. And we're seeing now that that's starting to open up, where carriers, insurers, brokers are starting to become aware of the issues regarding mortgage lending compliance and are becoming a little bit more willing to try and align these policies with agency lending requirements. Um, Sometimes I used to say, oh, I think it's just me. I think that the market's changing a little bit. But we've really heard this from a lot of our lender clients across the industry, that they're starting to get a little bit more information and, a little bit more latitude in asking questions about these specific policies. Obviously, that's not the case everywhere. We still have some difficulty in getting carriers and insurers to provide us with appropriate information, but it's starting to change. And the industry is starting to understand, especially the insurance industry is starting to understand that they have to ensure that their policies are compliant with lending compliance, or these condominium properties are going to remain unavailable for lending or become unavailable for agency lending. And that is a very difficult place to be right now. So that all being said, let's jump into it. So Mercedes, I'm going to ask you to come in here. Can you talk a little bit about the flood policy and Fannie Mae and Freddie Mac's guidance here?
Yeah, definitely. So this applies to property and flood coverage, and it speaks to actual cash value versus replacement cost, like a guaranteed or 100% replacement cost. We are seeing properties where the claims are decisioned at replacement cost for, say, most of the property, but then you'll have actual cash value for just the roofs. And it might say roofs over 15 years old, or have some other determining age factor that's going to make that actual cash value determination kick in. And that has been a serious challenge because the current guidelines are that you cannot have any part of the policy decisioned at actual cash value, even if your roofs are 2 years old or 5 years old. So it's like it doesn't really apply, but they just don't want that in the policy at all. And so we're seeing where I'd say more in Florida, but it really can happen anywhere, where just the roofs will be actual cash value and you don't always notice it. And so our team here at CondoTek, we actually, if we don't have the full policy to double check in, we do go out and ask the insurance agent very pointed questions to ensure that, hey, can you please confirm that this limit is 100% replacement cost, claims are decisioned at replacement cost, and no part of the policy is, analyzed at the actual cash value. And most of the time it's all right, but you always get those ones that come through and they have actual cash value, which is a problem.
And on that note, I mean, obviously that's going to bleed into the other slides in this presentation, right? Where I think we have an actual cash value slide coming up in a second. But are you starting to see that insurers and agents are starting to understand that this is a problem? Is that like happening in the industry? Have you seen that recently?
Yes, I would say initially when the guidelines first started becoming effective, the agents were already potentially feeling overwhelmed with all the questions we ask, because at CondoTek we are very thorough. We want to know every little detail. And so sometimes the initial response was, look, we already said it's replacement cost, look at the cert. And then slowly, as they're seeing, oh, this is becoming an issue for other lenders as well, not just someone like CondoTek, but having other lenders ask them and seeing all the changes in the industry, then they started saying, okay, yes, I can confirm. They're even putting it on the cert sometimes that it's, claims are actual cash value. That's a little less common. I'm sorry, claims are not actual cash value. That is more uncommon. So typically what we're getting is that email. Most of
Got
them
it.
are getting comfortable with actually giving us that email attestation.
Got it. Got it. Got it. Thanks. And then, the other piece of that is, as I said earlier, I mean, this is starting to come full circle. So you're going to start. Yeah, I mean, my prediction is, I think a lot of insurers, and I know this for a fact. I mean, I'm personally getting calls from large carriers across the country, helping them to align all of their policies as a whole to agency lending guidelines, and trying to point them directly to the agency lending guidelines where they can find them online and how to align those policies. I'm also hearing things in the industry like, well, I'm in this state, and in this state, the insurance law says this, and we can't comply with these lending guidelines. And we've heard that before. And unfortunately, we don't have a solution for them. So it's been a really difficult time for us because, look, we hate to say no. We hate to say a project is, or property or condominium association is not compliant, but often we're finding that they are. So here we go. Actual cash value and functional replacement cost, Mercedes.
Yeah, so this can throw your whole project into the unavailable bucket, into the ineligible bucket, so to speak. The master policy has to provide that claims are settled on a replacement cost basis. And in Fannie's mind, having actual cash value really is limiting the replacement, is limiting that value that the association should be getting back. And so we see that, and we hope that the agent has a way that they can adjust the policy. And when that happens, we just continue on with our review. But this actually makes an entire project ineligible. And this does apply to your Fannie full reviews, but also your Fannie limited or, Freddie streamlined reviews, because this applies to property and flood insurance. So unfortunately, you can't, not that we want to get around anything, but you can't have that workaround or that other option of a limited or streamlined review.
It's really important, right? Because we've heard in the industry so many times, oh, we're taking this limited review, so we're not going to look at this. And that's not the case. I've heard it over and over, oh, we're not going to comply with, the budget requirements or the 10% line item for reserve because it's a limited review. And we're also not going to comply with the insurance requirements. Okay, your project is going to be ineligible for residential mortgage financing. We're sorry to tell you.
And I hate
And
to
then,
say that
yeah.
we work with a lot of lenders who follow portfolio guidelines. We have many, various partners. We're doing various review types, and they're following the Fannie insurance requirements. Portfolio lending, they'll give some exceptions for other items, say commercial space over 35%, but they're not doing it for these insurance, such as actual cash value and deductibles, which we'll talk about in a future slide.
Yeah, that's actually a massively important topic here, right? We are, even, we have so many lenders that we work with that we always hear, well, lender A will call us and say, well, lender B is closing in this building. And that used to be the conversation we'd hear all the time. We say, well, they're likely closing under portfolio because the project is, and holding in their portfolio because the property is not compliant with agency lending guidelines. And we're not getting as many of those calls lately because portfolio lenders or lenders who are holding these loans in their portfolio, by and large, I guess there are a couple exceptions everywhere, are really aligning with these requirements. So replacement cost, Mercedes, what's different here? What do we see here?
Yeah, so for here, we hope our certificate just says 100% or guaranteed replacement cost. Some agents have policies where it's just their personal company policy not to write that on the certificate, and they'll just say replacement cost. And then you'll see other things on your certificate that give you a little red flag that maybe this isn't 100% or guaranteed replacement cost. Maybe it's got co-insurance, which could potentially reduce the payout that the association gets. It may not be a sufficient policy. And so what we're having to do is we're checking the policy if we have it, the full policy pages, but usually we're just getting a certificate to start. And so we're going back to the insurance agent and asking them if they can verify essentially this. Agent, can you please confirm the coverage limit is at least 100% of the replacement cost? And then we use this exact
blurb from the guidelines. If they are not comfortable answering, we can ask them for their replacement cost estimator or their risk appraisal, whatever they've used, to determine what the sufficient property limit is. And we'll be comparing that to the limit that's on our insurance certificate to make sure that it's sufficient. And we just put that in the loan file, and then we're good to go for that, for the one of many insurance items that we have to verify.
So on replacement cost estimator, will every insurer provide how they arrived at their replacement cost? Will they provide you with the results of their replacement cost estimator or appraisal?
Sorry about
Have,
that.
have you seen, I mean, I'm leading you here, right? Have you seen a lot of yeah, a lot of insurers be willing to give you their replacement cost estimator or their appraisal on that property?
I wouldn't say a lot. I'll say it depends on the state. Florida, there are some rules out there in the industry that have been interpreted by the insurance agents as meaning they are prohibited from providing us with this replacement cost estimator, whereas others have interpreted that rule to say you're not required to provide the replacement cost estimator. So we get them from Florida occasionally. It really just depends on the insurer, whether they're willing to provide it and whether they've interpreted that law to, say that they're allowed or feel comfortable providing it. There is an option that is, we don't really see it much, but associations can go out and get their own estimator, their own insurance risk appraisal. And we, of course, could accept that. We're not getting any strange ones where someone who isn't qualified just put something together. They've been from reputable companies who have experience in providing these types of assessments. And so it's less popular, but it is something that we've seen.
Yeah, thank you. It's funny. There's something else that's happening in the industry, and I'm gonna guess it's gonna take probably 3 to 5 years to happen. But a lot of these, replacement cost estimators we're finding to be incredibly low. You kind of cock your head when you're looking at these things, saying, "Well, the units are all selling at $1 million a unit, and their replacement cost estimator says the entire property is worth $50 million, but there's 200 units in the property." Kind of, the math isn't mathing, right? It just kind of something doesn't make sense here. And we're starting to see a major uptick in insurers' replacement cost estimators. So what obviously happens in that case, right? Insurance costs are going to go up even higher based upon this replacement cost estimator, and or in a risk insurance risk appraisal or an appraisal on the property, and that's starting to happen. So the guidance is, that we're seeing in the industry or that we're providing is, look, we think your insurance costs are going to go up even higher than they currently are. And I feel legitimately terrible for some of these associations that we talk to, when we are talking directly to the associations and to the boards, because, like, well, we just increased our insurance policy by $70,000 last year, and now we're seeing another increase of $32,000, and for this insurance policy. And unfortunately, we really don't see a reduction in these costs in the future. In some cases, we're seeing massive increases, or we expect massive increases to insurance costs, especially because of all the acts of God that we're seeing across across the country.
And this is having a big trickle down effect into other parts of the associations, both the integrity of their building and their financials. And so if you've got no option and you have to spend a higher premium to get sufficient coverage, how are you going to put enough money into reserves? How are you going to afford to do other things that are really imperative to the health of your project? It is definitely really upsetting for us, and we even see other related domino effect issues such as litigation. You might have maybe a managing agent who unfortunately doesn't have time to find their next the next insurance because their prior carrier's canceled, and then we're seeing where that causes some issues within the board and the managing agent's relationship. We've seen some litigations related to that. So it's really puts the associations between a rock and a hard place.
Yeah, for sure. Okay, agreed value and replacement cost again. Let's run through this.
Yeah, so the coinsurance guidelines used to be that if you had a policy that showed coinsurance, you had to gather some additional information, sometimes that valuation to tell you that the insurance limit was sufficient. And now that's been removed, which is nice because you've got one less thing that you have to that you've got to review. But they've kind of replaced it with double checking that your actual limit is a minimum of 100% replacement cost. So you've kind of just changed the cost to just kind of change the time that you're spending on the coinsurance, and now you're spending it on something else, which really the essence of the coinsurance guidelines were surrounded by, do you have enough insurance? Is your limit sufficient to replace the building to its current footprint in the event of a full claim? And that's what we have here. They've removed all the coinsurance. I would just say if you see coinsurance, that's just a little red flag in your head. Make sure you're double checking those replacement cost guidelines, making sure that the limit's sufficient, because sometimes it is that they have coinsurance because they've got a reduced rate and they may not be sufficiently insured.
Yeah, great advice. And here's where we see a little bit of difficulty in the industry as well. The perils in broad coverage form. Can you outline what the issue is and where we see the difficulty and where we see what's not listed sometimes in the perils, and also geographically, where are we seeing this?
Yes, so the form type for the insurance certificates, when you get that, it should, if you get the Accord forms for property insurance, that's great because you can just see that they've marked the box and it will say whether it's special form, broad, basic, what that form type is. And Fannie and Freddie, they are very similar in a majority of the guidelines, but there are a couple of differences with insurance. One of them is that Freddie says you need to have special form as your bare minimum, and they require you to cover all of the specific perils listed in their guide. Whereas Fannie does also recommend special form, but they'll allow if it says broad form, as long as all of those perils are listed in the guide. It's essentially, you don't want basic form, which it will say on your certificate or in the policy, and you're always making sure that you don't have any of the required perils listed in the guide excluded. So if you've got something excluded, say wind coverage, then the HOA has to have sufficient coverage for that in a standalone policy, and you do have to gather that information. Usually the agent is happy to just put that on the certificate, and they'll put what the policy expiration date is, all the details for the policy, which is important because, as we'll see in a future slide, you have to double check the deductibles for that peril and for any perils that are listed in the policy. And so going back into the agency guidelines, just to double check that if they say a peril is excluded, or if you find out one is excluded, you want to make sure that that's acceptable per the guide, because there are perils that are allowed to be excluded, if that makes sense. And I have the guide up right here, and I was going to just double check because I think earthquake was one of these. Let's see, I'm just gonna, sorry to do this on the cuff here.
No, it's important.
Yeah, here we go. So if I pop into the Fannie Mae Selling Guide B7-3-03, all the required perils like fire and lightning, explosion, etc., wind, they don't list earthquake. So if you get a certificate of insurance and it says excludes earthquake, or you just find out during your review that it excludes earthquake, that's not listed as a required peril. So that would be one where it's all right that there's an excluded peril because it's not a mandatory peril. It would be nice to have it if you're in an area where there are lots of earthquakes, obviously. And so you might make an internal decision like, hey guys, you got anything going for earthquake?
Right.
This thing's located right there. But yeah, that's just an example. You want to make sure all of the required perils are listed, and you are required to double check. Having special form, I haven't seen where there's special form where it excludes anything really more than wind, but you should always double check.
Really important info. Okay, back to coinsurance for a second, right? I mean, we just kind of went over this where both agencies replaced all co-insurance guidelines with the clarification, that the policy coverage, limit represents 100% of the estimated replacement cost. This is a reiteration because we like to kind of title everything, so we try and tie off all loose ends here. Um, Next is inflation guard. This comes up pretty regularly now, right? So Mercedes, you want to outline what the issue is and why and how do we fix it?
This is one of the newer requirements, and it's required for all of the policies unless you find that it is unavailable for Fannie Mae and not applicable for Freddie Mac. And that's where the insurance agent is your best friend because the expertise you would need to know as just an individual condo underwriter to know whether it is unavailable or not applicable, depending on the agency for that project in that particular market, it's just too much. And so the associations and the property managers should be informed of this while they're shopping, but that's where we all come in. Is we can ask that insurance agent, can you please confirm first, is it included? If they say no, then that's where you have to ask them, for Fannie, is this actually available for them to purchase? And if they say yes, then Fannie, if they were to do an audit of that, they were going to expect that you would have had that coverage added before you said that the insurance was compliant. But sometimes you'll have an agent say, we don't offer that to any of our associations because the policies that we provide are they kind of make this inflation guard null and void. Maybe they have some kind of extended replacement cost and some other features of the policy that really make it where they don't even offer it. They wouldn't offer it. Not that it would be excessive, but it's just not necessary. And so you might get that and be able to clear it. Or you might get, no, it's not available. The carrier doesn't offer this. And again, for Fannie, you would clear it. So just depending on which agency you're speaking to, you want to make sure, is this applicable to the coverage? Is this available for purchase? And you just document your file accordingly for that. A lot of people will ask, well, how much inflation guard do we need? And Fannie doesn't regulate that. So we usually see 4%, but there's no number. You might have 4, you might have 6. As long as it has inflation guard, if available for Fannie or if applicable for Freddie, then it has to be in there and the percentage doesn't matter.
Every time you open up your mouth, Mercedes, I'm sitting here listening to you. I'm going, oh my God, this is so nuanced. Not that I didn't know how nuanced it is.
Yeah.
But it's just, it's such a nuanced, aspect of condominium project review, right? And of course we know that, but we get so many questions from lenders on a specific policy when they send it off to us, and even especially when we're denying a particular site because it's not compliant. Obviously, the originators and the lenders want to do everything they can to close the loan within a property, and they'll ask as many questions as they need to of us, and we're happy to answer them. But and it's just an interesting point in time in condominium project review because there are so many questions that are surrounded around insurance policies, right? So, thank you again. Thank you for that decade of working here. Deductibles. This is the big one. I mean, look, let's go back to inflation guard for 1 second. The other point I have to make here is that if, we used to ask this question about a year ago or, 6 months ago, and we would, have like silence on the other end of the phone sometimes where they're like, what are you talking about? The carriers, the insurers, the brokers were like, in one instance, I had a broker, respond to us saying, what's inflation guard, right? I mean, it's not uncommon sometimes. Again, as I said before, it's starting to change, right? We're starting to see them understand that agency lending compliance is really important and the insurance industry is coming along. So not saying that we're there on every site yet, but it's getting there. Deductibles, we talked about this a little bit at the beginning of this discussion, where we're seeing uh, condominium and cooperative associations, in order to reduce the cost of their insurance policies, they are increasing their deductibles. And that has been, in many instances, as done as a result of a suggestion by the broker. Hey, if we can keep this policy number down if we increase the deductible to 25%. And condominium board members, not all of them are industry savvy and they don't understand the implications of increasing their deductibles. In most instances, that's what we've seen happen. Like, oh, we had no idea this was going to be non-compliant. And now, again, we're starting to see insurers understand that anything above a 5%, anything that exceeds a 5% deductible, is non-compliant. So Mercedes, anything to add there? What are you seeing?
Definitely seeing per unit deductibles. So a lot of time the base deductible, say for your property insurance, will be like 2 or 3% of the grand total building limit for the entire project. And that's great, but then we'll go on to like the comments section and see, or sometimes there's a little extra, there's a separately named peril in there, maybe water, and that will have a per unit deductible. And that's where we're seeing a lot of the issues is once you multiply that by how many units you have, a lot of times it's been going over the 5%. And you've got a little wiggle room there in the guidelines for specific deductibles, but not all of them. So anytime you've got where it says it's a per unit deductible, it has to be for a specific peril that's common in that geographic area. So the guideline says a named peril, I think specific to a geographic area. And so let's say it's just water damage. You got a per unit water damage deductible. You multiply that by how many units they have, and it exceeds the 5% of the master property insurance coverage amount. Water is not specific to a geographic area, and unfortunately, we're having to deny some for that. Whereas you might have other perils that are specific to a geographic area, like ice damming is considered common and more specific to the Northeast. And so if you've got one where the per unit deductible is for ice damming, it exceeds the 5%, then that's one where you can still proceed. And there's some little extra part in the guide where it tells you that in that instance, you then have to make sure that the borrower has their own policy. It has coverage for the applicable peril, ice damming, that any deductible assessments that are levied on that unit owner for that peril is covered by their separate insurance. And it has to be sufficient. So you just want to make sure that anything in excess of the 5% is going to be covered in that individual owner's policy as well. And so you're happy that if it's over 5% for ice damming, as an example, and the projects in the Northeast, they are able to proceed, but then you have to do that extra little review for the borrower's insurance policy to make sure that it's sufficient to cover that separately named peril.
So as I said, nuanced, right? There are, a lot of if-thens when you are reviewing an insurance policy for a condominium association or a cooperative association. Thanks, Mercedes. It was really well explained. Per unit deductibles. Now this has become this is blown up. I mean, we are hearing so much about per unit deductibles across the US from carriers and from lenders. And, what are the biggest issues here? What are we finding here? What do the agency guidelines state here?
Yeah, so this is kind of what I was chatting about before, where you've got to make sure it's specific to that geographic area or you're out. Unfortunately, gosh, I can understand it though. The associations need to cut their costs in any way that they can, and they're taking a risk there. But they're like, what are the chances we're going to have to file this claim, have some major loss, and so they're having that deductible increased. But we are seeing water as an example where after you add them all up, it ends up being over the 5%, and those are coming out as unacceptable or making the project ineligible. And I know we're going to answer these Q&As in the future, but for windstorms. Someone had asked about windstorms, and that is considered a required peril. So you can't have your windstorm excluded.
Are you answering questions or notice? Oh my God,
Oh,
I
I just
can't do
noticed
that.
one.
By the way, I can't notice it. I can't. It's so difficult for me to do both things at the same time. You're multitasking. Okay. Special coverage requirement for project developments, building ordinance or law coverage. Another issue. Look, we had an interesting one the other day where we were working with an association, and they realized they didn't have building ordinance or law coverage in their policy, and they were flagged as unavailable for lending. And they, were having some, lots of difficulty getting mortgage financing. So we had a call, we did a lending compliance report on the property, flagged the fact that this was one of the issues with their insurance policy. And I was talking to the board president on a call because we once we do our lending compliance report, we come over the top and we have a call directly with the board so we can explain what we found. And we found that without having that call, they kind of don't pay as much attention. So it's really important for us to discuss it. And the board president said to me, he's like, well, we knew that this coverage was going to cost us an extra $30,000 a year, and we were just kind of biding our time
Ugh.
until somebody forced us to get it. And I said, well, you don't have to get it, but you also, are not going to get residential mortgage financing approval through the agencies. So they kind of, bit the bullet and, added it to their policy in order to become compliant. And we're seeing that happen more often than not. Again, back to the carriers, the brokers, the insurers, they're coming up with creative ways on how to reduce the cost of their insurance policies as a result of these increases. And this is one of them. Is that what you're seeing too, Mercedes, in your reviews?
Yeah. Yeah, and this is a tough one because maybe folks will see, oh, you've got increased costs of construction. Well, I have inflation guard.
Right.
Or demolition costs are covered. Won't that be covered in my extended replacement cost or inflation guard or some other part of the policy? And unfortunately, we're having to check, is the ordinance or law these components A, B, and C, all of these included? And if not, is the HOA able to obtain it? Is it available to them essentially for purchase? And someone else had a question. I forget the person, but it was basically the guideline indicates that it's not required if it's not obtainable in the market, not unavailable by the carrier. But the current state of the market is that they have very few carrier options. That carrier might be the only carrier. They're the only one in town. And so it's kind of, one washes the other. It's, really it's not available in the market because that one carrier they're able to get the insurance from doesn't offer it.
Yeah, great point. And what about boiler and machinery equipment breakdown coverage? Because we didn't hit on that yet.
Mm. Yep, if you've got the like heating, air conditioning, say a cooling tower that services the entire project versus the individual owners being responsible for maintaining their own individual heating cooling units, then you do have to have the boiler and machinery coverage. It usually is listed as equipment breakdown, and the coverage amount has to be at least 2 million, actually the lower of 2 million, or the replacement cost value of the building housing that machinery. We handle a lot of projects in New York City and a lot of high rises, and typically the limit is just the same limit as the total building limit. It ends up being the same, but you will get other projects depending on the construction style where it's a lower amount because they've got that equipment is kind of in its own separate area from the main building.
Mm-hmm. Yeah, that's great. And we're nearing the end here. Not all the way there yet, but flood insurance. What are the changes here? What are the thoughts here?
I would say this guidelines pretty much remained the same.
Same. Yeah.
Yeah, pretty much. We really prefer to get that RCBAP or replacement cost, the building association policy declaration page for review versus just getting some data on their certificate if possible. And that will tell you what is the replacement cost, how much do they have, what is the deductible, and then the key here that's really been highlighted in the past maybe year and a half, 2 years, has been contents coverage. We've got some policies where they say they don't have any contents coverage for flood, and that we've got to go and check, well, do you have contents in the building owned in common by the HOA? Or is this a
Mhm.
really bare bones where there really isn't anything that needs to be insured in common for that contents coverage? And that, again, insurance agents are best friend, and we're having to go get some additional data from them. But checking the contents coverage has been the main change, I'd say, in the last, say, here, year and a half for these flood insurance policies. We haven't had very many that I can think of where the flood master policy was just completely insufficient as their base limit. They pretty much will have at least 80% of the project's replacement cost, or that building's replacement cost. I haven't really seen many where they've got less than that, and it's completely ineligible. But the contents coverage has been most important lately.
Yeah, it's great. Great intel. So, as always, thank you. We're going to answer a couple of questions, or attempt to answer a couple of questions. Boy, we nailed it. 45 minutes, and then I
That's
got some
rare.
questions to answer. It's rare. Um,
Yeah.
we always throw this slide up here. Everybody who has attended this call will receive a copy of this presentation along with some of the answers to the questions if we can answer them. There is some contact information. You can always email Mercedes or I if you have any questions. If you'd like to order our products, you can contact sales@CondoTek.com and they'll get you set up. In order to do that, whether it's a condo pack or a condo project warrant or a co-op project warrant or a lending compliance report now, or even a global site-wide project approval through the PERS process or through VA or the FHA, we're happy to help get those associations down the road towards approval. And again, that lending compliance report product, I feel like I'm hawking it. I feel like I'm a sleazy salesperson. But I have to tell you, it's been a really interesting time for us because the lenders that we work with have looked to that as an incubator product for future lending, and we're really proud of it. And it has worked really well. I have to, say the following disclaimer about that. In many instances, we find that condominium associations are not compliant with agency lending guidelines. But by doing that lending compliance report, it does tell them how to get compliant, and it's in black and white, and it's real. And what we've seen is that these boards are taking these reports back that we're providing, outlining them in unit owner meetings, or working with their property manager in order to align the site. Some of these properties are going to take, a year or 2 or 3 years to get compliant, especially some of them that have critical repairs, deferred maintenance, structural or mechanical issues, or financial issues like they don't have enough in reserves, or they aren't collecting reserves appropriately, or that they have some sort of massive litigation on the property or a litigation against the original sponsor developer. But by getting that intel or that information, they have now a plan on how to get compliant, and that's what we're seeing the most benefit. The other side of this conversation is really surrounding our our condo project warrant product. As you can see, the insurance review is a large aspect of our condo project warrant. Mercedes, would you say that it takes the most time of CPW report, or half the time, or a quarter of the time of our review?
Gosh, yeah, I guess it depends on the project.
Right, right.
Yeah, we've
It's
got some very interesting projects. We've got some folks who have asked for a review and they just don't even know what's wrong with the project.
right.
And then, we're able to help them there and show them, oh, look, this is everything that's compliant. Here where your issues are. And then we have other sites where they've got challenges. They've got maybe construction defect litigation. They've just settled and they're trying to get all the work done in time, but there's a list of 140 defects. Where do they start? They're trying to prioritize everything and make sure they have adequate funding. So it's been very interesting, but really, really helpful for the board. So all the work we have to do is worth it.
You always sound so cheery. And when you communicate this to our lender clients and board members, they always feel good even after getting the worst news sometimes. Yeah, we really strive to ensure that these projects are compliant, and we're warranting them to our lender clients. So it's important for us to be right. That being said, let's see if we can answer a question or
Yeah,
two.
I was
I
gonna
don't
say,
know.
why don't we
Let's
pop
jump
in
into this
here?
for a second. Yeah. Let's see what we got, Mercedes. So the Q&A. Do you want to pick one or two,
Yeah,
or
sure.
go
I did
ahead?
reply to one. Someone had asked for a cheat sheet for the perils,
Huh?
and we don't have one, but you could definitely easily create one. So I popped in the link for the Fannie Mae guide, and you got to scroll a while, but there is a little graph there, and I would say to copy paste that bad boy into a Word doc. But definitely make sure if you see a selling guide announcement come out, or if it's been, 45 days, don't keep referring to that. Go back into the guidelines. You don't want something to become stale and you're referring to it and it ends up being, it's no longer active because the guidelines have been changed. But definitely, I would pull that out of the Fannie guide and then pull out of the Freddie guide, and you'll be able to make some little cheat sheets in that way.
Yeah, it's great. Great intel.
And then,
Um,
oh, go ahead.
no, you go ahead.
For folks are saying if we see wind, are we separately validating hurricane? That's a great question. In the Fannie guide for the little perils chart I was just chatting about, they list windstorm, and then in parentheses, they say including named storms designated by the US National Weather Service. So I would say if you see that it has wind but says excludes named storms, which I've seen, then that's going to be a fail. But we don't actually look for the word hurricane. So we're just making sure it has windstorm coverage, and it's only an issue if we're seeing that it specifically excludes named storms, named with capital N.
That's a great question and a great answer.
And
Uh,
then David was saying they removed earthquake insurance a few years ago, especially in California. I am jealous that you're in California, David. So nice over there. um, but yes, we no longer have to, earthquake isn't considered a required peril for Fannie Mae. And so if you see that's excluded, then that is fine.
There's a bunch of questions about will this recording be available? Yes, we're going to provide you with the recording along with the presentation and trying to answer any questions we haven't answered. Shortly, I'm going to say. Sometimes I used to say, you'll have it this afternoon. And then inevitably we would run into an issue, some sort of tech problem, and wouldn't be able to get it out. So my new comment is you will have this presentation, a recording of this presentation shortly. It gives me a little bit of a buffer so that I'm not saying something that isn't accurate.
Yes. And then Heather was talking about replacement cost, getting, really specific on that verbiage on your certificate. So does it saying 100% replacement cost or RC or 100% replacement cost value or RCV, are those all equally acceptable without going back to the agent to say, hey, can I have your estimator, or can you confirm the limit meets, insert the guideline blurb about replacement cost? And then they also said Fannie Mae confirmed GRC, which is guaranteed replacement cost, wasn't sufficient to basically say this limit is enough to restore the property, and saying that many agents are pushing back on this, saying GRC has no limit. And I would have to say, of course, we go with what Fannie Mae says. They are the determining factor, and it might have been that particular project you were emailing them about, or maybe at that time they wanted to make sure that they were being extra cautious. But I would agree with the agents that if it says GRC, there is no limit. Sometimes they have a rateable limit that they're using kind of in the back of their minds, so they make sure that they've got sufficient coverage set aside for that project. But guaranteed replacement cost usually doesn't have any limit, and so I would say that that would be sufficient.
Mhm.
However, in the latest insurance climate, we're going back. It does take a little extra. We are going back to the agent. We know it says 100% replacement cost. We know it says GRC. Can you please just confirm via email that it meets this? in an email. We've got something for the file, something for the loan file. It does seem redundant, but that's just what we're doing because of the current climate. And I think that's going to go by the wayside, in the coming months
Yeah.
as these guidelines have been sussed out and they're getting feedback from insurers and lenders.
I feel like there's an announcement kind of brewing about this, and again, it's just a gut feeling, and I think there'll probably be something coming out from us about this shortly, to our clients. But yeah, this is one of those things where we're getting the question asked 100 times, but we're a belt and suspenders firm, right? We
Yeah.
go out and really ensure that the lender is not going to have an issue with selling their loan. We're warranting that
Warranting.
loan
Yeah.
review, for God's sake. So we have to be sure.
Yeah.
And again, one of the comments we always make to our lender partners is, look, this is what we think about the file. You have the freedom to close this loan should you disagree with us.
Yeah.
And in some cases, we have had lenders close loans if they disagreed with our findings. I won't give you the percentage of times that they had to repurchase those loans when they disagreed with us, but I'm going to tell you it was a lot. And then they had to put it into their portfolio or sell it scratch and dent or whatever. And it's just a horrible place to be. And that's not a cocky comment. That's a comment that is, we are in uncertain times right now. And lending compliance is for condominium and cooperative properties is incredibly important. And you know, it's incredibly unique, right? It's not like lending in a single family property. As you all know on this
Mhm.
call, I'm telling you what you already know. There's a question here that I want to get because we only have a couple minutes left, Mercedes. Um, and it's from Mary Pat Rupp, who asked a question. And I'm sorry, I'm not getting to everybody's question today. I didn't promise I was going to, though. But this is a good one. It's the last question that popped up. I don't know if you see it. How to
I
condo
do.
that's,
Yeah.
yeah. So let me read it out loud and then I'll hand it over to you to answer. How to condo that shows is unavailable on CPM. Fannie Mae says it's because the insurance was a citizens plan only, used as last resort to save money. Is there a website where we can search insurance companies' ratings to make sure they are acceptable?
Yes. Yeah, I'd say the easiest to use for me has been ambest.com. You create a free account and it's pretty easy to search. There's also DemoTek, still user friendly, maybe slightly more difficult. And then there's Standard and Poor's. And unfortunately for me personally, that one is a little more difficult. Their user interface, they've got a lot of great information on there, but it's always a little more difficult for me to use that particular website. And so I tend to go with AM Best first. It's saved on my computer. I just pop in there, it pulls up the ratings. And then if I cannot find the project or the carrier there, or if it is listed as NR, not rated, then, or maybe doesn't have an acceptable rating as required by the guide, then I'll go over to Demotech and I'll be able to search the Demotech site. We don't have very many where we can't find it on any of the three. I will say Citizens, you've got the Citizens Fair plan, which is the state insurance for Florida. There is another Citizens, and we've had it where we just type in Citizens really quick, get the NAIC rating number, just to double check that you're pulling up the right one, to make sure that this isn't one without a rating that Fannie accepts, like the state's plan Citizens versus the other Citizens. So you just want to double check that you're looking up the right one, and asking the agent for the NAIC number is usually the best. So yeah, definitely the best. ambest.com, I would say, is the easiest.
That is great intel. Well, look, so we're nearing and that's the last question we're going to do today on this presentation. I would really like to thank you, Mercedes, for spending this time with us today and providing all of your knowledge to this large group of people that's on this event today, on this webinar today, and to the entire team at CondoTek, which is which you're working with in order to get these projects reviewed quickly and accurately. So we can warrant them. Thanks for everybody who joined today. Again, just as a reminder, you are going to receive a copy. If you are an attendee, you're going to receive a copy of this presentation and a recording. You will also hopefully get a bunch of answers to some of these questions shortly, as I said earlier. So thank you for attending our webinars. We have another one in the state of Florida tomorrow for about 40 or 50 credit unions that asked us to present to them. So we're busy here, but we're going to try and get this information back to you as quickly as possible.